Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, July 25th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It's been quite warm here today in Colorado. I've been splitting time between sitting here at my desk and painting the back patio of my house. And that faces south. And I've been basically barbecuing all morning and afternoon. And now that I come inside, clouds. Unbelievable. Unbelievable. It's just kind of luck I have. Right, Jake? Right, Jake? Give me a thumbs up, Jake. He's not very excited. Anyways, I'm glad you're here at the Liberty Call. And if you would, please give me some thumbs up, like, share, subscribe, follows, all that good stuff. I would greatly appreciate it. Hit that notification so that every time I go live, you can listen in on all the ramblings that I talk about. All right, let's go ahead and jump into the numbers for Tuesday. The Dow Jones was up 0.08%, 26 points, closed at 35,438. S&P 500 was up 0.29%, closed at 4567. NASDAQ up 0.61%, closed at 14,144. The VIX fell 0.29% today. It's currently at 1387. Canada was down 0.15%. Let's see, Brazil up 0.58, Mexico up 0.92. Over in Europe, Germany was up 0.13%, UK up 0.17%, France down 0.16%, Netherlands up 1.07%, Spain down 0.25%. Italy up 0.2, Switzerland up 0.48, and Portugal up 0.09. Russian exchanges both green again today. MOEX up 1.29, the RTSI up 1.49, and the overnights, starting with the Nikkei in Japan, it was down 0.13%, not too bad. Australia up 0.46, New Zealand down 0.79, and nothing but green in China today. Kind of a change. We've seen a lot of red here of late. In China, the Shanghai was up 2.13, the Shenzhen Component up 2.54, China A50 up 3.41%, DJ Shanghai up 2.32%, Hang Seng up 4.33%, and the Taiwan weighted came in flat at up 0.02. All right. So I didn't expect much from the markets today simply because, this is the first day of the Fed meeting. And everyone's just on pins and needles. What's the Fed going to do? Oh, my God. Are they going to raise rates? Are they going to lower rates? Are they going to print more money so that the stock market goes? I mean, we know what happens when the stock market goes up because they print money. It goes. Anyways. All right. Well, let's jump into the market recap. S&P 500 rises on tech strength ahead of Microsoft Alphabet results. Let's see what they have to say. The S&P 500 recorded gains on Tuesday, driven by investor interest in tech stocks ahead of the quarterly results from tech giants Microsoft and Alphabet, as well as the Federal Reserve's upcoming decision. Both Alphabet and Microsoft saw their stocks climb over 1% ahead of their quarterly reports. Investors are particularly focused on Microsoft's cloud segment Azure, which is seen as a key indicator of the overall cloud and enterprise spending environment. The street is expecting 26% growth for Azure. For Alphabet, investors are watching for signs of improvement in the advertising market, updates on AI investments, and the performance of its cloud business. The broader tech sector also received a boost from chip stocks, with NXP Semiconductors leading the rally. NXP beat guidance and quarterly results driven by automotive growth and impressed investors. The company's partnership with Chinese EV manufacturer NIO Inc. for 4D imaging radar and China's EV tax credit subsidy provide further tailwinds. Verizon Communications reported mixed quarterly results, with quarterly revenue missing Wall Street estimates. However, an unexpected rise in its wireless subscriber base due to enterprise customer base expansion offset some concerns. GM's quarterly results beat analyst estimates, but the stock fell over 3% as CEO Mary Barra announced plans for additional cost-cutting measures, raising investor fears about potential impacts on new product development. They're probably sitting on a bunch of those electric cars. I know I read an article last week or heard someone talking about it, that Ford's sitting on a bunch of their Ford Lightnings. Shocking that a bunch of men don't want electric trucks. Who knew? Alrighty, where was I? On a positive note, GE delivered better than expected quarterly results and raised its full-year guidance, sending its share price to a 52 two-week high, rising over 5%. However, Alaska Airlines guidance dampened investor sentiment for airlines despite reporting quarterly results that surpassed analyst estimates. The airline's projection of slower revenue growth for 2023, missing Wall Street estimates, spooked investors. This sentiment extended to other airline stocks, including Southwest, American, and Spirit Airlines. Overall, the tech sector remains in the spotlight with big tech companies reporting their earnings. Investors are closely watching the Federal Reserve's decision, anticipating its impact on the markets. All right. So again, everybody's just kind of waiting around to see what the Fed's going to do. It's probably not going to, it would be more shocking if the Fed didn't raise rates this time, or, say they raised it 50 basis points or 0.5%. The data doesn't look great. The forward-looking stuff. The rear-looking data still looks really good. Jobs, labor, those sorts of things. But typically, your businesses aren't going to start firing and laying off people until they really, really have to, especially after 2020. It's hard enough getting the lazy young people to go to work every day. All right, next up, U.S. dollar flat as market awaits clarity from central banks. The U.S. dollar remained relatively stable against a basket of major currencies on Tuesday as investors turned their attention to central bank meetings scheduled for the week, hoping for guidance on future monetary policy. Positive signs of a resilient U.S. economy have helped the dollar recover from a recent 15-month low, while ongoing weakness in Europe has also supported the currency. U.S. consumer confidence reached a two-year high in July, reflecting a tight labor market and receding inflation, which bodes well for the economy in the short term. However, concerns remain as a survey from the Conference Board indicated that consumers are still apprehensive about a potential recession in the next year, especially after substantial interest rate hikes by the U.S. Federal Reserve. Market analysts anticipate consolidation in the Forex market leading up to the Fed meeting, but they also expect elevated volatility as investors wait for additional guidance from the European Central Bank and the Bank of Japan later in the week. The dollar index fell slightly by 0.108% to 101.280 after touching a two-week peak of 101.65 earlier in the day. Meanwhile, the euro declined for the fifth consecutive session, down 0.13% to 1.1048, as evidence of a slowdown in Europe becomes apparent. A recent survey revealed a record low in demand for loans in the Eurozone during the second quarter, and separate data indicated a decline in business confidence in Germany this month. The upcoming central bank meetings, starting with the Federal Reserve on Wednesday, followed by the ECB and BOJ, Bank of Japan, are likely to influence the market significantly. Investors will be closely monitoring earnings reports from major companies like Alphabet and Microsoft today. The Japanese yen strengthened by 0.38 against the greenback, trading at 140.92 per dollar, while the British pound rose 0.5%, reaching 1.2896. In the cryptocurrency market, Bitcoin increased by 0.42% to 29,261, and Ethereum rose by 0.5% to 1859.50. All right, so that's what's going on in the monetary world. Again, everybody's just sitting around waiting. All right, last up, we got from our friends at the Mises Institute. It's titled Price Inflation Slowed to 3%. That's still too high, from our friend Daniel Lacal. Let me get my summary up here. All right. The recent University of Michigan survey revealed that one-year price inflation expectations in July rose to 3.4%, up from 3.3% in June, while the five-year outlook also increased to 3.1% from 3% in the previous month. Amidst a growing mainstream narrative in the financial media, there is an argument that accepting 3% annual price inflation is a successful measure in combating rising prices. I don't think so. However, this viewpoint is met with skepticism as it fails to consider the long-term consequences of such inflationary trends. 3% annual price inflation sustained over a decade would result in a loss of purchasing power of the currency of 34%, which in an already inflationary environment could have disastrous effects. Rising long-term price inflation expectations not only indicate a severe erosion of real wages and savings, but also act as a strong incentive for sustaining inefficient and unproductive sectors of the economy, like the U.S. government, for example. Moreover, price inflation is not just a hidden tax due to excessive government spending fueled by artificially created currency, but it also hinders innovation and technological advancement. Amidst market demands for more quantitative easing, evidence from the past 6 months indicates that the surge in the S&P 500 has primarily been driven by multiple expansion, while sales and earnings growth have remained weak. The growing reliance on easing and multiple expansion could lead to a weaker economic growth, lower productivity, and declining real wages. A 3% per annum average price inflation rate has significant consequences for essential purchases, leading to higher costs of food, utilities, gas, and other necessities. The June inflation reading was particularly concerning as it showed rising prices for most items instead of the expected decline. Inflation is primarily caused by the increase in the quantity of currency in circulation beyond real demand, with government spending being a major contributor. Inflation, in turn, results in the loss of purchasing power of the currency issued by the central bank. The consequences of inflation have been evident in significant price increases for essential goods and services, leading to negative real wage growth and a shrinking middle class. Ignoring the destruction of the economy and the middle class to justify more government spending or marginal gains in asset values is very short-sighted. The economy should be driven by a thriving middle class and productive investment, not by government spending on financial assets. Continued monetary easing may not be the solution to strengthen the economy, but rather a path that weakens the foundations of progress. All right, so that was basically a little summary of what inflation does to us and how it harms us. Basically, you can use the rule of 72. Whatever the inflation rate is, let's say is 10%. Divide that divide 72 by 10 gives you 7.2, which means that the cost of living will double every 7.2 years. So, not a good thing. All right. That's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope you have a wonderful evening, and I'll talk to you next time. Adios.